Okay.
Now I'd like to talk a little bit about mutual funds. There were 2 acts that were enacted that changed the landscaping for investing in securities. The Securities Exchange Act of 1934 and the Investment Company Act of 1940. These 2 acts were enacted to regulate the industry. An industry that continues to evolve, innovate, and get more complicated all the time. So what is a mutual fund? In simplest terms, a mutual fund matches a pool of investors, like you and I, and a pool of securities. Without a mutual fund, we average investors could not invest in the thousands of options out there. Launched in 1976, Dalbar has consistently earned the recognition for consistent and unbiased evaluations of investment companies, registered advisors, and insurance companies. Dalbar awards are recognized as marks of excellence in the financial community. Since 1994, Dalbar has been measuring the effects of investors' decision to buy, sell, and switch into and out of mutual funds over both the short-term and long-term timeframes. So according to the Dalbar survey, over these 20-year periods, you see the actual investor compounded results. These results may surprise many people because they see their 401ks growing over the years, but they don't realize how much of that growth is return on investment and how much is just their monthly contributions. And on top of that, you read the reported returns on the prospectus or marketing materials, but what is not obvious is these are gross returns. They do not reflect all the fees they are paying. These fees include the expense ratios that, according to Morningstar, average 0.9%. Then there are the transaction costs that average 1.44%. Then you have spread costs and cash drag. All, when totaled, average about 3.17%. These fees are not on your monthly statement, I assure you. Bottom line, results are consistently show the average investor earns less, and in many cases, much less than the mutual fund performance reports would suggest. So the average long-term results according to Dalbar is 3.42. That's the average. I make this point for this reason. When planning for retirement, we must be realistic in our projected returns. We have got to stop using inflated returns in our calculations. We want to make every effort that we are using good numbers and that we are facing reality. We are making decisions now that we will have to live with later. For many of my clients that I work with, one of their biggest fears is that they will outlive their money. And that is a legitimate fear, but if we are going to address that, we must start real numbers. Take a look at a difference in projected balances of $1,000 per year invested over 20 years. Look at the difference in 8% and a 4% return. That's a whopping 36% reduction. How many of us would be prepared to accept missing our retirement mark by 36%?